In this video, I'm going to talk about how you record the issuance of bonds. Now, we're going to first do the par, and that basically means the company's going to pay a stated rate that is equal to the going market rate. If that is the case, then the marketplace is happy with receiving what's stated on the bond, and it will sell for each bond will sell for $1,000, and that's the quote right here. That's how it would be quoted: 100%. That's what these are. The bond quotes are percents times the par value, and there's 200 of them. So the amount of cash received will be 200,000. They're going to then credit a liability because now they owe 200,000. They have 200,000 of somebody else's money. Now what they're obligated to do is that they're going to have to pay interest every year in the amount of 10,000 because that's the 5%. That's their obligation. So you're going to be, your P is the 200,000 times 5%. That's stated right on the bond. Okay. Now, how often do they pay their interest? In this example, I'm going to do annually. Had it said semi-annually, what it means is that every 6 months, the bondholders, whoever buy the bonds, will receive 2.5% every 6 months, which is equivalent to 5% per year. All right. The other thing is they're obligated, besides paying the interest each year, is in the third and final year they're going to have to pay back the $1,000 per bond, or $200,000. So that is a contractual obligation that is printed on this piece of paper. It cannot be changed.